It's the Market Sniper. How are you? Fellow friends, my feathered friends, my fluffing our plumage. It's time to fly south. Yes, we're going to be talking to you about the energy complex looking weak and potentially downside for the likes of the general categories of uranium and oil as well, to match that which we've called already on natural gas. By the way, if you've first time visited to our channel, we've got some history with the energies. I will remind you, and we will have this pinned in our notes in the description below, in fact, on our macro call regarding oil. From the very big initial point where we were discussing how oil was looking weak during the pre-COVID events, you can click on the macro link, see the actual trades, the individual equities, the whole piecing together the entire COVID strategy. What's less known though, because we don't always make a good job of bragging, although we've banged on enough about this, is the top was actually also called by us here at 129 on the subsequent rally. So not only did we call the capitulation, we also have previous history with oil in 2014 when we called the crash from 113. I don't know why it turned out that way. I don't consider myself an oil man. I don't consider myself a mining man. I would have preferred maybe it was a different market, but it is one of the most important and critical markets. So we have history in 2014 calling the great collapse that actually took out the lows of the subprime crisis. That's right, on the big falling wedge that you'll see over here. And that's also detailed how and why. You'll learn a lot technically from just case study following in separate trades. So just see it as an interesting case study. We'll show you that big falling wedge. That's right, this fall over here. We were not part and parcel of the major subprime fall. That was more about a banking collapse that had its effects. But we were a part there, and we were shocked to see it run the depression low. This was, of course, a secondary sell-off leg that set up what ended up being the 3 impulse macro monthly virtually, or was it 6 weekly? It's 1.5 months falling wedge structure. And then we were getting short and we were saying this is a critical break. By the time this had already happened, it was already February of 2020 and we were in Acapulco. But you could have got short way up in the mid 60s over here with us. In fact, we got in twice and we detail that. The first time failed. So this is an important point with trading. People think that your first entry is just your golden entry every time. Sometimes you make multiple entries because you're squeezing with tight risk. Before the one wins out, and of course the risk reward was absolutely huge. So apart from what happened here with this particular move, we also subsequently, as I say, were aggressively calling the top at the 129. We pointed out this was an exhaustion gap, quite likely. This was really grinding along our splitter, and you had a final stab up and full take back of that stab up move. There was a marginally higher high that was in and around the $129 mark. This was on Western Texas Intermediate, as you can see over here on oil, which is the high post the events of March 2020. So what are we saying today, and why is this all interesting? Go and have a look at this link for some back history. But while everybody is watching the banking crisis, by the way, we'd also drawn in our community the small bank ETF. Many of these best ideas coming from community members, by the way, and then we do the drill down. So we've done a full draw on this fella. And in fact, it popped up again in our live trading day that you could have attended as well on the Friday. And we were highlighting first the Monarch head and shoulders. We're the only one who uses that phrase. It's very specific. It's about the one that's top of the top of the top. It's the smallest, because you sometimes can get embedded larger ones. This is a bit disproportionate to call that tiny shoulder on that. So it's a bit winging it. It's a bit far. But nonetheless, we saw the grind line. We also saw that this whole rally occurred after the Monarch's target was made, all the way back up to the neckline. If you understand and you want to grow in price behavior, and you can appreciate the value of getting the key levels of significance, then you'll appreciate what the Hunt Volatility Funnel method actually does for you. Anyway, nonetheless, that was a spill and it had real big gaps in it, and I'm not sure it's entirely done. But for now, peace and love and savings, and people are talking about rate cuts now. Will the Fed actually not tighten at the next meeting? So that's all kicked into play. Why? Because Biden had to come out. You know you'll trust him, don't you? Don't you? Just look at him around the kids and you just know you trust him implicitly to say that everything was safe and all the managers have been fired. Thank you, Joe. Well done. Good job. And the shareholders will take the loss. And none of it has come from you, although we backed it with, the fund that they all contribute in. That's also backed by the taxpayer and all that. Well, never mind. Let's not get into the weeds. So that was the banking collapse. We also saw, as part of that banking collapse, Credit Suisse hitting new lows. Credit Suisse doesn't want Deutsche Bank to feel lonely as being the only walking zombie being kept alive on promises from central bankers. And so it's dashed to new lows at 2.51. But is there the next potential crash in the energies? And that is the theme of what we are going to talk about. So let's get straight to it. Before we go to the oils, though, however, there is the energy complex, which also involves gas. We started warning that gas wasn't looking right on the sell-off over here. It was getting hyper volatile. It had feigned to make a new high. That was heading November into December. Initially, in the August period, we were thinking there could be dark days for Europe. But suddenly, yep, that gas price sure as hell was coming off really badly, and then it set up this structure, and we made the call that you were likely to get a sub-3 price on gas after hitting the giddy heights of 10 up top here at around 5.4. That was the head and shoulder draw, and in fact you traded as low at its lowest point in and around 2.1s. So gas has already fallen, fine friends. Now, it's a different energy, of course. It's not as easily transportable. You have to liquefy it. There's quite a lot of different traces. But energy going down, now this is an activity tax. It's also an end of, you do get a seasonality, of course, with winters, particularly when you're talking about gas. But oil and uranium, well, we see a bit of a dark cloud over them. So what could it be? It could be recession, depression, aka stock market crash, consumers stop spending, events, dear boy. In other words, financial matter, derivatives, bank bailouts, etc., which is why we started pointing out the SPDR small banks ETF that we'd already drawn, that ended up leading into the Silvergate Silicon Valley Bank without us even having to have been there. But what about the oil market itself? Now, one of our community members reminded me and webinar leader to always take the dollar out of it. We talked 360-degree analysis, and he did a nice draw, and he reminded me of that. So full credit to Ollie, who had me go and check again the oil, but take the dollar out. You see, the dollar has become part of the problem. It's not stable at all. It's not the stable token to measure Bitcoin against. There's nothing stable inherently in it at all. And in actual fact, we did this as a little draw. We took the dollar out of the equation, and we'll get there in the end one more time. We put the Dixie instead. So we put a little bit more of a general currency feel that is Western of nature. So let's see how that chart panned out. Here you'll see our draw. And as I've said, the 360-degree analysis that a community gives you, and being reminded to do what you should be doing, and just taking the dollar out. Sometimes I look euro, but this was actually a good idea. The amazing thing is when you look at this, and I want to just show you, I said about WTI, that the WTI to the community and during the live trading day, along with gas, didn't look right to me. It looks like it's not a bottom and it's going to fall. But it didn't have the clean structure that I wanted it. I talked about the inverted non-smile and the inverted watermelon smile, for want of a better phrase here, of zigging and zagging. Like that, typically, especially around the 75 level, as being representative of likely potential continuation with this convexity. But however, I think you will agree, indeed, that once you take actually the dollar out of it, it's just tidied up even more our ability to spot that which we were seeing. We had already commented that we didn't like the lie of the land for uranium, and this has also been an area where we suspect that there will be some downside, the nuclear side. But is it exclusively uranium? So now that we've pivoted back to this chart that I wanted to show you. Okay, Jesus Christ, how many alerts did I have on for freaking Ethereum? He's determined to take over this YouTube. Thank you. Ethereum is bumping. There you go. Now you know. Can we go back to energy? So back to this chart. You will notice that left shoulder, big broadening pattern for us. This blow off head. There's your 129, by the way, in dollars. The high that was called by us after, don't forget, all the smackdowns, including 2014. I'm going to get divergent again here. 2014 and the single digit run that actually took you to naught over there. So going back to our weekly view, in fact, we can take it into 3 daily and even 2 to get the full view. You can see that coming uppance all the way up, bull market that we said would reinflate, and then the 129 as high. You never quite made it on the subsequent rally, and you've petered all the way down. And in fact, the key level here is in and around the 0.7-ish. The 0.7 is our neckline. Now, bear in mind what that is. That's close to $70, $75. The Dixie is around 103, 104. So you're dividing by 103, 104. So it's not exactly $70 because you're not dividing by exactly 100. So what do we have? A head and shoulder that is actually indicating a run down to a 0.38 on the Dixie index. That's going to be, assuming the Dixie index stays reasonably flat or level. I doubt it will. In fact, we're seeing problems for the dollar. We're seeing more problems potentially coming for the dollar. We actually see the euro getting a bit of a benefit. That's why you're seeing those Ethereum alerts going off as Ethereum goes up, and no doubt you will be seeing some Bitcoin bullishness ongoing as well. So what does this draw do? Well, it's a massive head and shoulder. We have a 0.38 Dixie valuation, so it's about just under 40% of whatever the Dixie index being the dollar value of oil. So if the Dixie index is in and around 105, 106, and you're going to end up running to 38% of that, you're going to be looking at oil around the $40 mark. Bearing in mind that it's currently trading at around 73.5 to 75, falling to 40 is still a significant call. You could, of course, overperform that to the downside. Sometimes in the real, if we get crashonomics and it's recession based, it could also be peace breaking out in Russia, Ukraine. I don't take that one too seriously. It could also be lockdown, variant, some other garbage, summer flu, climate change, or any other agenda that sees people being restricted in their freedom of movement for flight and driving around. I certainly hope it's not that movie again. We've had enough of that one. No sequel required, he says. But anyway, whatever it may be, if it's derivatives, banking, financial collapse, a summer of discontent in terms of the markets and hypervaluations, we can see oil going to the low 40s, possibly a nose below 40, actually having a 3 in front of it. Why? Because it's going to be on this target, if performed, 38% of whatever the Dixie is now, which is around 105. So it's going to be borderline 40 or just below as a target that we will have in terms of dollars. Now, that is quite extreme. This is classic of having inverted HVF structures as right shoulders in our complexity on a broadening structure over here, and then of course, as I've said, the key level where we armpit out over there and there. You will learn about complex head and shoulders with us. There's a nice little Batman ears for you, and down she comes, but a very clear head it is. And you will also learn on how to scale, when to scale across time frames for different pattern sizes and structures. You'll be learning a lot more. In fact, you'll be growing and hopefully making good money trading alongside us at the same time as implementing and getting better at your technical trading skills in a community of like-minded that are of high quality people. This is not a Telegram group for a stipend at the end of each month. Book a call, the very first link in the description if you wish to go and see further. So overall, we're seeing this devaluation. We think you might get a little bit of a rally first. It's not yet ready to have its triggering event. I think that will be led by news. of some form or variety, and we could end up in an early collapse or demand destroying event that is economic of nature. That will automatically be very, very mean and hard on the energies markets as a whole. We've also mentioned uranium in all of this, and of course this will extend into equities as well. So let's go further and discuss this once again. So uranium now recently had quite a good run, by the way, but let's have a look at it at its core level. It's here she comes. So this is uranium. Now I actually think the oil is probably better set, but if they go down, they probably go down together. So you can see the bull run that uranium has had. It's been oversold for a long time, but this overall, if oil is selling off, will have a negative effect on it. And we feel that could in fact be a change in trend over there and a squeezing that is seeing a potential. You could rally back in one more time before that goes, and it will also likely have downside. Will it be to the exact same magnitude as what looks like at least a 40% sell-off in oil? Not necessarily, because it's been unloved for far longer. You don't decide to open a nuclear reactor overnight and switch it off overnight because the temperature changed in the markets for the uranium. In fact, many people might actually acquire uranium at lower prices and enjoy being able to do that. That has had an effect on a variety of other proxies for uranium. You can see I can switch to the global X uranium ETF, and you can see literally the structure remains the same. You should see that. It's combinations and correlations in ETFs, and again you see a little bit of similarity even here on Uranium Energy Corp, which is a corporation which not so long ago in the events of March 2020 had a low in and around, where was she? Tell me now. Low of 35 cents and then charged up to $6.60. So that was quite some recovery that you're looking at around almost 20x as part and parcel. However, now you're at 338, 39, and we feel also that this could relapse to the downside. Overall, I wouldn't expect these to fall necessarily as far as some of the oil-based plays. Remember, oil had one of the fastest snapback re-inflations in price and is the fulcrum of the Rockefeller tax and its role in society and recovery, and will always be skimming. So we've covered natural gas, we've covered the oil, and we've covered uranium at the broad level. There's also, did I show you? Yes, I showed you uranium. So what about a couple of equities? Well, we did with Josh Young a couple of equities in the small cap energy. I just feel it's an unlucky time for Josh now, in that there's some of the ones that he was watching are going to sell off. So I think he's right, and it's an interesting place, small cap energy, but I just think it's not a great moment for it now. I think it too will potentially come down. It was of course devastated in the events of March 2020, but has recovered a great deal. But I think it's recovered enough to about to get another slap in the face, kind of getting up from being knocked out and then only to find the same guy punching you as you're standing up. It kind of feels that way a little bit for the small cap energy, and this too is inverted structures, first in a new trend, which will typically bring you overriding performance to the downside, over performance. So with Sandridge Energy, we expect further downside, and we expect the $10 to be run. We were short, suggesting it's short way up at 15 and 16 range. It's now trading at the 13 range. So this is good progress to the downside, but long run, these kind of things will come back when the inflation trade comes back. Also, Blackstone Minerals was also one of his picks, and we just felt again that these things are going to run into a spot of bother, and that is a little bit trend change ish, and there you broke, you return move, and you are selling off as well. So since that interview, in and around the 16s and 20s zone, you're now trading the 14s. So that's also a little bit down. Another group that he pointed out was Midby. That was on the high side up top here when we did that interview, and has also since turned down, showing some momentum to the downside. Let's have a look at an index. This is one that's got a very clean inverted HVF, first in a new trend, all encompassed within a far larger head and shoulder potential. So this is our concern. Demand destroying event. That's my phrase. DDE. Oh yeah. That's right, erectile projectile. Here she comes. This is what it looks like. There's your left shoulder, there's your head. Let's actually give you a 2-day view on that instead. This is part of your head, and we think this inverted HVF structure with a target in and around the 27.5 is going to bring this currently at 31, tapped out at around 42, down, down, down. So we think you've got a complex head as part of a journey down with a left shoulder waiting for its right shoulder that I've drawn long in advance, and this is continuing to bleed out to the downside. So we continue to expect to see the IPART Bloomberg Commodity Index, which is heavy energies, go adrift to the downside, with a very potential. You can see where the entry and the improvised stop would be, and the overall low would take you all the way down to around 18 in terms of our expectations on the head and shoulder. Yep, that's it. So that's a little bit on an index that is capturing quite a bit of energy action in it. What else do we have? Well, inside our community, we've looked at a couple, a few quick hits that you might consider, and you would see broadening structure there, quite technically interesting again, broadening again, breaking through. This is again complex head and shoulder territory. Big grinding up head, right shoulder over here, spilling. We'd expect to see at least a 50% loss on this when we were calling it over here. It's now already well on its way. You could have been short from in and around the 220, and you would be looking for sub $1 on ring energy. So these are all quite ominous signs for a number of things. This is the Uranium Royalty Corporation. Again, as I say, a lot of head and shoulder, typical type pattern action. Big run-ups, now coming back down. Key levels there at the 3, just run, hanging in inverted structure. You're seeing the same pattern dynamics explicitly expressing themselves, where you'll get an inverted target and a far larger, on a bigger time frame, downside target, which could see you again at 123 on something that you could have been short at 3s. 123 target, short at 3s. You're calling on individual royalty companies like this Uranium Royalty Company. Essentially, that is a 60% loss in value. There's a whole bunch more that I'd love to show you, but we do this in our community. You've got to respect the community members, and also the fact that people that have invested do really well with something given for free is rarely acted on. This is a key psychological aspect. In fact, I show you a little of what's possible and give you something that you have opportunities to trade, but at the same time you recognize that if you have got some value, you can smash the links button, and if you would like more of that value and to get a better idea and to be in the community, you book a call utilizing that first link in the description. Also have a look at the macro trends. So it looks like a downer for energy. That's the conclusion that I've come to. This could slow down some of the bullishness on gold and Bitcoin, but I see those now as money alternatives when the world has become far more concerned about banks, debt, and fiat currency, all of which go hand in hand. So you could see those being stubbornly resilient in spite of any recessional or demand destroying events. Hence why you might get crypto alerts on the likes of Ethereum whilst you're doing an energy YouTube. I hope you've enjoyed this. Remember, none of this is advisory. Trade small, develop skills. This is for your general entertainment. And represents my personal opinion, utilizing a self-derived hunt volatility funnel method perfected over 30 years, written up, presented, recorded professionally with slides, real lessons, and a community that are all trained to a high level, executing well on one key strategy, where you are squeezing risk and looking for highly expansive moves in a volatility contraction into a major volatility expansion. If you understand why that is a smart strategy, we might be for you. Thank you for watching, and we'll catch you again. And till the next time, salute.